Hi everyone and welcome to Symax Fintech's weekly market insights. As usual, let's just get past the disclaimer. So trading involves the potential risk of loss of capital and is not suitable for everyone, but yes, I hope it is for you. As some companies provide leverage, just be a little bit careful of that. You can lose substantially more than that initial investment. The views, opinions, everything contained in this is just solely for educational purposes. We're just trying to help set you up for the week ahead. And of course, it does not constitute investment advice, or we are not encouraging you to trade or invest. That has to be your decision. You should carefully consider the risks involved, your financial situation, definitely your level of experience and your risk appetite. And of course, you should only risk capital you're prepared, but more importantly, you can afford to lose. Don't risk too much of your capital. Any doubts whatsoever, seek independent financial advice before you risk that capital. Make sure you know what you're doing. Understand trading, understand the markets. We're here to help you with all that. We provide courses in all different types to help people. Even if you're doing one of these competitions, you want to get you haven't got the capital yourself, so you want to get that capital funded account, they call them. So if you want that, then again, we provide a preparation course to help you get ready for them. So, reach out to us. We'll certainly help you. Our contact details are on the last page. Okay, so here we go. Highlights of last week. So, earnings continued to be mixed. Tech shares dumped. When you look at the value, absolute billions wiped off of their shares in the last weeks. Meta dropped big 20%, and it also dropped out of the top 20 stocks as well. And of course, these earning reports are mixed because you've got banks and energy companies that are performing well, but the tech shares just are disappointing. The dollar. So the dollar weakened a little bit. Now, when we look at that is, for me, it's with expectations that the Fed's going to slow down their rate rises and that they're perhaps coming towards a close. Personally, I'm not so sure. They're going to want to see inflation down and stay there. So even if they stop raising them, they're not going to drop them again. They're going to leave them up there for probably 3-6 months at least to sort of have the confidence that they've beaten inflation. And of course, as we know, and we keep talking about it, they can try and control the demand factor, but they haven't got any control over the supply side. So Musk finally bought Twitter, and of course the first thing he did was get rid of some of its execs. And I think that he will trim down the numbers a lot more than he has already. And of course he's also planning to revoke the bans, these lifetime bans that were given on certain people, including Trump. So maybe he'll actually come back on and start tweeting again. We'll have to wait and see on that one. But it will be interesting if Trump comes back, especially, of course, with the midterm elections round the corner. ECB raised their rates 75 basis points. So they doubled the rates, basically. And, from what they're saying, we've still got to expect more. So their rates at the moment still, behind most, but 1.5%. Refinancing's at 2%. When you think they was at negative 0.5, I mean, at least now they're back into that positive territory, which is great. And of course, Japan hasn't done that. Japan is still negative. It refuses to join the band. It's left its rate unchanged at negative 0.1 and adding more stimulus. And that is despite the fact that their inflation is creeping higher. It's now up to around about 3.5%. Now, Canada, again, surprised because they only actually increased by 50 basis points. That puts their rate at 3.75 now. And of course, you know, they want to wait and see. They're expecting that the rate hikes that they've put into the system will start to take effect. And you know, now they just want to hold back. They don't want to be quite so aggressive for the moment. Sunak, our new UK PM, you know, they pushed the budget back to mid-November because they've got to find about 50 billion from somewhere, and that's going to be potentially from tax increases as well as spending cuts. But you know, you can expect austerity in the UK, which is not going to be helpful when there's a lot of pain already being on the low and middle earners. You know, with high food prices, high energy prices. It's, you know, recession's around the corner for sure. Okay, so US GDP was positive, so it takes them out of that technical recession that they was in. Now, US PCE came out, and that was, you know, it just stays sticky. You know, it's one of the key metrics for the Fed, and you know, it's not coming down. So again, don't expect the Fed to slow down these rate increases as fast as possibly some investors are now expecting. And you've seen that this week because the stocks had a bump on the upside. And you know, that was even despite the fact that manufacturing PMIs were low everywhere, you know, in pretty much all the countries, Europe as well as the US. Consumer confidence is still weak. In the US, it's stronger, of course. Now, you know, we are coming up to the US midterm elections, 8th of November. Just make a note of that. And it will be interesting. I'm actually doing a sort of a chat show webinar in the evening of that day with some guys in the States from Ninja Trader. Okay, and then China data improved, although retail sales was lower, and you can expect that to continue for the moment with these lockdowns. And you know, they seem to be coming more rather than less. And just a little bit of a reminder, the clocks changed in Europe and the UK this weekend. We went back an hour, and so that's, if you know, if you're in Europe or the UK, that is going to impact the times that all of the US data comes out for the next week. The US do their clocks next weekend, so it's only for 1 week. Okay, so moving on to this week. First of all, happy Halloween. Have a great time. Again, you know, it's a fun time, celebration. So some countries are bigger into it than others, but you know, it's great for the kids for sure. We're going to see more more Q3 earnings, well, UK as well, but everywhere. And it'd be interesting to see how they continue. So that extra hour in bed, just to remind you, it's the US next weekend. So the US data is going to be an hour earlier this week. So, you know, just remember that if you're in Europe. So US, we've got manufacturing data. You know, that's going to provide an insight into consumer demand. Now, ADP, I don't usually worry too much about ADP. You know, it's an employment indicator, but it excludes the government hiring and firing. But I'm going to watch it more so this week because it's on Wednesday. And of course, the FOMC meeting is after that. So it's, you know, they're going to, because they're having their meeting before NFP comes out on Friday, they're going to be looking closer at the ADP number because they're going to use that as a little bit of a heads up of what they expect from NFP. Of course, they don't always match up perfectly. We've also got some PMIs and ISMs coming out from the US. But, you know, really, Friday is going to be the key one. after we get through the FOMC meeting. Inflation's not really dropping. You know, even if you see this drop in demand, or it's starting to feed into the data, you're seeing this little drop in demand, but prices aren't coming down. When it comes to the NFP, I'm much more interested in the earnings and hours that are worked for me, because that's inflationary data again. Coming on to the UK, again, we've got manufacturing data. And of course, we've got the Bank of England on Thursday with the MPC meeting. Now, you know, this one's not quite so strong. This could be 50 or 75. You know, because UK politics has been in such a sort of chaotic state caused by the Tories recently. And of course now Sunak and Hunt are now looking for this extra 50 billion, you know, potential tax hikes coming, etc. It's going to drain from the system. So, you know, the Bank of England might only do 50 instead of 75. The EU got some retail sales, a little bit of GDP, inflationary data there, a little bit of manufacturing. So again, just keep an eye on all that, because it is going to impact the euro. And then Japan, Bank of Japan minutes are due. So again, to sort of find out if there was anybody actually talking about bringing the rates even to zero, let alone positive. Or whether they, you know, at the moment they just don't seem keen on it at all. You know, are they going to be proved right? Probably not. You know, I mean, this cheap money's gone. It's not going to come back anytime soon. With Canada, we've got PMI and employment data coming out, and in China, manufacturing. You know, they got lockdowns, but those lockdowns are increasing. So again, you know, as you see going on to sort of the November, looking back at October data, and then in December looking back at November's data, you know, there is potential for that manufacturing to drop just because of these lockdowns. And as I say, the lockdowns are becoming more rather than less. So inflation outlook. So, you know, we've seen that those earnings were mixed with the tech stocks performing badly, you know, wiping billions off of their company valuations. Now, but of course, you know, we've got households that are struggling, and consumers will not be rushing to replace their phones or tablets, you know, tech stuff basically, maybe even for the next couple of years. You know, they'd rather just stick with the model they've got. You know, everyone has a must have the new stuff out, but it's a matter of affordability, and at the moment that's dropping off. However, we are seeing banks, energy companies, supermarkets performing well. As I mentioned earlier, you know, the dollar weakened. You know, investors and traders expect the Fed to slow down these rate rises. I'm just not sure they're right. Okay, you know, we might see a drop in demand, but if we don't see an increase in supply, again, you know, if we don't see inflation start to come down, then seriously, you expect the Fed to slow down or even stop these rate increases? Slow down possibly, you know, maybe a little bit more of a wait and see as this, you know, all the rises that they've done so far feed into the system. But personally, I think they've got more to go, and for longer. You know, supply issues are still there for sure. And you know, China's increasing their lockdown. Apparently, it's around about 210 million people that are currently contained. Of course, Musk completed buying Twitter. That included a few exec sackings straight away, as I mentioned. But there's, you know, a lot more staff that could disappear from there. This inflation is still the issue, though. It's not dropping as central banks were hoping by hiking rates. It's just not happening. And of course, that's a problem for them. But, you know, it's understandable, because if it's coming from the supply side, then there's not much they can do about that. Inflation. So, yep, there was Germany. Again, that their inflation is still increasing. And US jobless is starting to creep up, so keep an eye on those as well. Now, with inflation remaining high, again, we just got to wait and see the data as it comes out, because it's, you know, the central banks are becoming much more sort of reactive to the current data rather than necessarily just going forward with the strategic plan that they've created. They are willing to tweak that slightly if necessary, if possible. But until you see inflation dropping, I keep emphasising this. I don't think that they can. Even if they stop putting rates up, they're just going to hold them there. You know, I really believe that, and for some time. So we've got stagflations and recessions around the corner. How fast they're going to reach us is going to be different depending on the country, etc. But they're coming, you know, because with these rates up, you know, people can't, you know, household bills, food, energy, there's all these pressures on households, you know, for their spending. Okay, the US are in a bit more of a stronger position because all that stimulus that was done over COVID, you know, that's given US households a bit of a cushion. But, you know, that's a luxury that most of the rest of the world doesn't enjoy. And of course, you know, these supply chains could get worse again because of the Chinese lockdowns. Midterm elections, as I mentioned, are on the 8th of November. And again, you know, Biden's desperate to sort of, obviously, to win those or keep control of the houses. But I would say that's on a knife edge at the moment. You know, the consumers, okay, they've seen gasoline prices come down a bit, but you know what they're not seeing are food prices come down. They're not really seeing any benefits at the moment. And, you know, all they're going to see is that the money that they had saved is starting to be eaten away by inflation. Russia, Ukraine, still ongoing. I think it's the 9-month now. So, just doesn't seem to be in the end to that. Russia have been using more drones to attack because Ukraine has been making more and more ground towards recapturing lost sort of ground. As I mentioned, energy and food inflation is just continuing. You know, you would expect it to be a bit lower because, as far as I'm concerned, you know, food prices and energy prices have dropped. I mean, you know, if you look at oil now, it's sort of mid-80s. It was up to 130 after everyone panicked from the Russian invasion. Food prices, you know, they went well up as well, massively up. But they've come back as well. And then you've got Europe now that's at the moment, you know, they're in quite a good position with their gas because the weather in Europe has been quite timid for this time of year, quite warm even. And of course, that's put less of a drain on the gas supplies. They've managed to sort of rebuild them out. But as I said, you know, Germany's still got that inflation increasing. I think part of that was because they removed a travel subsidy that they'd put in. I think it was about €9 and you could pretty much travel anywhere. FOMC, we're going to see that 75 basis points. Anything other than that is going to be a massive surprise to the market. But of course, listen to what is said and the press conference after as well, because they're going to be very important. You know, they didn't start their rate rises until at the beginning of May. And yet, you know, they've been trying to play catch up and now they've sort of really leapt ahead of most. But those energy and food prices, you know, for me, wholesale prices have come down. They're much more realistic. For me, all I can believe is they're almost close to where they were sort of pre-Russia's invasion of Ukraine. Gas obviously a bit higher still. Oil still a bit higher, but overall, you know, nowhere to where they were. and of course those reserves have increased. Funny, just on the sort of the metaverse, just want to mention something on there before I carry on with all this. It seems that Hollywood's now favouring Roblox, ROBLOX, that is, for all the stuff that they're posting in the metaverse. So that's interesting. Okay, getting back to this, just want to mention that because I'm a bit of a fan of the metaverse. Supply chain issues still there. China lockdowns, 210 million lockdown. That could still continue to increase. It's going to make it more difficult. So that again could dampen supply chains. Russia's invasion of Ukraine continuing. As I say, we've got the energy and food inflation, lack of workers. Earnings pressures are still there, although I expect a lot of these jobs to start disappearing. I mean, jobless claims is slowly, quietly increasing in the US. And of course, we've got this US-China sort of decoupling, it's called, where Biden's trying to slow down China's sort of tech advancements. He's restricting some of the technology that's available to them to try and delay their advances in tech. Of course, that's okay, but you're only going to keep them for so long, and then they're probably going to motor ahead anyway. All right, so now we've sort of looked at that. Let's trading tip this week: trading psychology. Impacts about 80% of our performance and our decisions. So if you've got that confidence, have you got confidence? Hopefully you have. If you've got confidence, then it's generally because you've had a good run in the way of producing profits. Confidence-wise, if you've got a lack of confidence, it's usually from underperforming, losing, maybe even revenge trading, or you've become overcautious, you're becoming more nervous about going into those decisions. You're doubting your trading plan. Hopefully you've got one. On the other side of that is this overconfidence. You've got a string of good positive results. It almost makes you feel invincible. And again, just be careful. That can be really dangerous because you go all in on one of your trades because you feel that confident, and the market just waits for you to do that, and then it just gives you a little bit of a reminder that the market's rule, not us. Okay, so technical analysis. So our chart legend, just to go through it as a little reminder in case you're new. Black numbers support resistance levels in the right hand axis. Brown numbers indicate breakouts unless they're part of the pivot points. And claret numbers, they're just horizontal levels where I've sort of either visually identified support and resistance where I expect it to be, or we've got double or triple tops or bottoms. Fibonacci, it's just obviously the base colors there. So again, just sort of keep an eye on them. It's useful even just to take pictures of these sort of things with your phone, just so you've got them fresh for the week ahead. Okay, so we're moving on to stocks to start with, and of course they continue to bounce. They're up about 10% from the lows now. However, this could be a defining week for stocks, with FOMC and NFP coming along. And of course, when we look at it at the moment, when we saw that rally last week, it sort of pushed them up. It's getting back to sort of some interesting levels, well, for me anyway. So I've got resistance, which goes all the way back to April, May of earlier this year. And they were good levels for me because I waited for that other bounce to buy some put options. And if it gets back up there, personally, I'm going to be looking to do the same again. So resistance levels at 34031 and also at 33508. Support at 31876. Just taken that off of some previous resistance more than anything else. 31336 and at 28,745, which obviously is a long way away now. But with these markets, who knows? I'm just going to move on to 30-minute. On the 30-minute, we're in that sort of up channel, short-term up channel. And, you know, we've had that good bounce since it sort of fell off. How long is it going to stay there? But I've managed to find a resistance level at 33,106 and support at 32,112. You know, so stocks are sort of almost reacting in a sort of inverse relationship with data at the moment, because, you know, if data comes out really strong, or the expectations are for the Fed to want to put rates up and keep putting them up aggressively, then, you know, that's been making the stocks actually come lower, because the expectations are less demand, recessions, etc., etc. So just bear that in mind. And now, when we look at the S&P daily, I've got resistance at 43.05 and support at 38.23 and 35.07. Then moving on, there's the 30-minute. Here I've got resistance at 39.58 and support at 38.67, 37.91 and 37.63. So, you know, it's going to, are any of these levels going to hold this week? You know, you'd like to think so, especially on sort of like the day charts and that. But, you know, with FOMC and NFP coming out, we could see a serious move this week. So Nasdaq was sort of lagging a little bit just because obviously the tech stocks have been disappointing. And as a result of that, I've got some resistance levels: 13,604, 12,940, and 11,736. And I've got support at 10,474. On the 30-minute, I've got resistance at 11,625 and support at 11,441 and 11,134. You know, Nasdaq's just suffered a little bit because of the tech stocks. So, you know, now earnings are sort of a lot of them are getting out of the way. We can get back and focus on sort of what's really happening in the economy. Moving on to the Russell 2000. Just remember, these are the smaller mid-cap stocks. So, again, they had a bounce. So now we're looking at resistance on the daily at 2033 and 1926, with support at 1795 and 1647. Russell on the 30 minutes, again, we've got that slight up channel. Here we've got resistance at 1861 with support at 1806, and, you know, support's the same as the daily at 1795 also. Moving on to currencies. So UK budget was delayed. As I keep mentioning, Sunak and Hunt are looking to try and find 50 billion from somewhere. This could include tax hikes, spending cuts. But again, you know, this austerity is likely to push the UK into a recession faster. But looking at the data, we've got resistance on the pound at 120.80 and 116.58, which is not far away from where it closed, and support at 110.65. You know, the pound did recover. It stabilized rather than recover, I would say, at the moment, based on the fact that we've got a new PM. Now, moving on to the 30-minute, I've got resistance at 116.44. I've got support at 115.18, but that's as a breakout. So if it breaks that, I would expect to see it go lower. And then the next support is at 114.61. The Euro daily, I've got resistance at 1.0907 and 1.0396 and 1.0123. So it's got back into sort of positive territory past parity. Let's see if it can stay there. Support at 09709. So moving on to 30-minute resistance at just over $1 at 1.0029, support at 0.9985 and also at 0.9964. Again, the dollar's going to move this week. First part of the week, it's just going to be sort of expectations. From Wednesday to Friday, it's going to be on the data and obviously the Fed meeting itself. So moving on to Bitcoin. I've got resistance, which is a breakout resistance. So again, if it breaks on the upside, it's well away from that. But I do like to put these in because you just never know how fast it's going to move when it does go. So that's at 27,330. I've got resistance before that at 24,440 and also at 21,180. With support at 17,560. Bitcoin 30-minute chart. Again here, I put the pivot points on some of these and you can see how they're sort of held into those. I mean, look at that. Looking at that S2 where the green line is at 19,970. Came down and tested that beautifully. And then it went all the way up to almost test R1. So it had a great sort of, you should really look at the pivot points if you're not used to them. If you don't understand them, reach out to me. I'll try and help you. I'll do courses on them. I like sort of basic explanations anyway. On the 30-minute, I've got resistance at 20,822 and support at 20,080. So I'm sure we can expect them to get broken one way or the other this week. Now, moving on. Here's the Bitcoin Nasdaq daily comparison that I like to do. It is a loose relationship. Let's be honest about it. It's at some at stages the crypto, the Bitcoin's been more stable than the stocks. The stocks have become more volatile. So we've seen a little bit of a transition there. But just remember, this is a loose correlation, but it's one that is looked at by a lot of institutions, which is why I put it in here. And of course, more of the traditional institutions are in crypto these days. Well, they were, hopefully they still are. Okay, moving on to commodities. So here's gold. Again, just a little bit lackluster from gold, it's just sticky around this 1650s. It doesn't really seem to know what to do. So on the daily, I've got resistance at 1692 and support at 1639. On the 30-minute, I've got resistance at 1662 and 1656 with support at 1646 and 1636. So again, you'd expect some of them to get broken this week. Finally, moving on to oil, WTI. So when we look here, got resistance at 96.38 and below that 89.80 with support at 82.85 and also at 78.80. Again, oil is sort of fluctuating around. It's having $3-5 moves in a day. I like to trade it. I tend to trade it more through strategies like calendar spreads, because you can control the volatility more yourself then rather than the market. Okay, and WTI 30-minute resistance 89.80, 88.75, and support at 87.26. So although it was moving around on Friday, it sort of hovered between sort of S1 and the pivot for pretty much the whole day. And again, as I say, you know, if you want some information on pivot points, reach out to me. Okay, so I'm just going to finish up and just point out some of the services that we provide. So, you know, this is just a small part just to help set you up for the week. But then during the week, we provide a daily newsletter, which does include global news, my views, and also fresh chart levels and pivot points each day. We do one-day workshops to help you fill in your gaps in your sort of experience, skill set that you have. We do 1 week courses that can help really take you forward, sort of accelerate your sort of career in trading. And then if you really want that boost, that sort of turbo boost, then if you go into one of our master classes, that can really help you to progress and really accelerate at a fast pace. On top of that, we do trading mentoring. So, you know, if you know, you're already trading but you'd like to improve, we can help you with that. We consult to companies for, you know, hedging for FX, raw material exposure. We also provide trader education, all different levels, and to traders, to exchanges, to brokers, provide content, webinars, etc. So, you know, we're pretty much overall anything to do with trading. You know, it's been my passion for pretty much 50 years now. So, you know, it's just great, isn't it? I mean, it makes you want to get out of bed in the morning for sure. Okay, so if you want to contact us, info@symaxfintech.com with any general inquiries. If you've got anything to do with trading that you'd like to ask me directly, then it's chris.tubby@symax-int.com. I look forward to hearing from you. Have a great week. You know, do your research, do your homework leading up to Wednesday's FOMC and Friday's NFP. And of course, if you haven't got the time to do that, then subscribe to our newsletter and get it off of us instead. But best of luck, and once again, happy Halloween.